So good afternoon everyone. My name is Maurya Hanspal and in this session we're going to continue our discussion on fixed income instruments. So in the previous session I talked about fixed deposits. And in the fixed deposits I was talking about the benefits, the advantages and the disadvantages of the fixed deposits. So the biggest advantage of the fixed deposit was that it was giving you a fixed rate of interest no matter what. Whether the market goes into the period of boom or a recession or in the period of consolidation. But the biggest drawback was the rate of interest was quite low because it was giving you a lower amount of risk. And the basic principle of finance and stock market, as we talk about, higher the risk, higher is the expected return, and lower the risk, lower is the expected return. And being FD, rarely being able to beat inflation because inflation is ultimately eating away your money, and that we try to understand. And we also talked about the Deposit Insurance Guarantee Corporation. Deposit Insurance Credit Guarantee Corporation. So it insures your amount up till 5 lakh rupees in the FDs. Like if the bank goes into bankruptcy or into losses or it's like shut down its operations, then your amounts are secure up to 5 lakh rupees. So in this session, we'll be introducing to you about one more instrument. We'll be talking about the government securities. We also call government securities as the gilt securities. Gilt securities. And this word gilt has been taken from the previous history because earlier all those government securities and all were pegged in terms of the gold or maybe in terms of currencies which had their edges in terms of gold. So that is why they were called as gilt securities. Again, the government securities are one of the safest securities. We have all kind of the treasury bills, bonds, papers, notes. All these things are present. And also because the government won't default on their payments. Because ultimately, if the government is defaulting on their payments, the faith on the government would be abolished. Like no one would be trusting the government. So that can create a loss of trust, a loss of harmony among the people on the government. And ultimately, the faith would be lost. And that is why the government won't be defaulting on their interest obligations on these securities. Okay, that is one thing. Like recently, also the government launched the RBI direct scheme in which the people could purchase these bonds uh, directly from the RBI side or from the government side, and they had to not go to the hassles of opening an account or like they have to go through brokers or banking systems. They can buy the securities directly from the RBI portal. Or RBI direct scheme was launched. RBI direct. Okay. So now when people talk about the government securities or the gilt securities, they think the rate of interest would be like very high because ultimately the government wants to promote people to like buy their securities because ultimately when the government borrowing program starts, and recently the government borrowing program is about to start once again. So what exactly is the government buying program? In the government buying program, ultimately the government is selling their securities or their bonds, right? And ultimately people have to buy those bonds and people would be giving the amount to the government, right? And once the amount is given to the government would be promising them a certain rate of interest, right? So what exactly like what do we mean by a bond? See, they won't be giving you kind of a big box or a big security. It's just in the form of a piece of paper. So on the piece of paper, it is just mentioned that the government of India, like in the case of the government, is offering you bond at 8% rate of interest, and like you will be getting this rate of interest like semi-annually or annually. By annually, I mean the rate of interest that person would be getting once a year, and by semi-annually or bi-annually, I mean the rate of interest would be get by 2 times a year. Okay, so it's just a piece of sheet or a piece of contract on which it is clearly mentioned or written. And the same thing happens in the case of a corporate or a company also, right? That when the company is issuing its securities or a bond, it won't give you a big bond or a big gold coin or something. They will just say that we are like giving you this piece of paper and you have to like supply us the money while taking into consideration all those legalities, and we'll be giving you a certain rate of interest. Okay, so the same thing happens in the government borrowing program because ultimately in the government borrowing program they're issuing their bonds or securities to the general public, and the public has to buy those bonds and securities in return of the government promise to give them a fixed rate of interest, right? So that is the basic essence of the government securities and bonds of like what really happens. But the rate of interest on these bonds or these securities would be very low. And why would the rate of interest on these securities or bonds would be too low? Because these are risk free. And you get a risk free rate of interest there because these are backed by the government. A risk free rate of interest, as we call them. Risk free. Risk free rate of interest because they are backed by the government. Okay. And even the RBI also helps in these programs, as we call them the open market operations. The RBI would be buying the government bonds and supplying them the money to increase the liquidity in the market, right? Now, when we talk about the government securities or government bills, people say that T bonds, T bills, T notes are one and the same thing. No, these are different things. Though they are the same in terms of the government securities, but the time duration is different. Okay. So, firstly, when I talk about the T bills are the and T stands for the Treasury bills. So T bills or the Treasury bills are the short-term instruments, like the most short-term. And you have like three kinds of T bills. You have the 91 days T bill, you have the 182 days T bill, you have the 364 days T bill. These three kinds of T bills are present. And see, you might get a certain rate of interest on the 91 days T bill or like 182 days T bill and 364 days T bill. But obviously, the higher the duration, the higher would be the rate of interest. Okay. And also, like in some of the bills, they're issued at discount and redeemed at par. Issued at discount and redeemed at par. For example, if 100 is the face value of the security, so the government would be saying that I am giving you at 90 rupees. So you buy at 90 rupees, and after a certain period of time, you sell it at 100 rupees. So you make a 10 rupees ka profit. Okay. But a rate of interest is given absolutely, but this discounting can also be that I told you. The second category when we talk about is the T notes. Again, these are the government securities with a higher duration. So when we talk about T notes, they are the Treasury notes. T stands for the Treasury. Again, the duration for these notes is more than 1 year to 10 years. If you are holding your T notes or the government securities for more than 1 year, we call them as a Treasury note. And again, they offer you a rate of interest biannually or semi-annually. मतलब साल में दो बार ही rate of interest मिलता है. You get a rate of interest twice a year. And the duration is basically from 1 year to 10 years in case of a T note. Okay. The third category we talk about the T bonds. T stands again for the Treasury bonds. And these are the proper bonds, a longer term duration bonds for more than 10 years to 30 years. And here also you get a rate of interest semi-annually. Like for example, if the government has promised you that on the T bonds that they are giving you a rate of interest of 6%. Okay. So 3% would be given in 6 months, and the rest 3% would be given in next 6 months. It does not mean that you are getting 12%, 6% in first 6 months and 6% in the next 6 months. It means total 12%, total 6% mil raha hai, 3% in the first 6 months and 3% in the next 6 months, and that you need to know because some people confuse कि 12% rate of interest मिल रहा है and 12 तो कहीं नहीं मिलता, 6 ही है, 6 को half में divide हुआ है. Okay, so these are called like one of the safest securities and the most safest securities because ultimately they are being issued by the sovereign or by the government, and the government won't be defaulting on their payments. The treasury notes, the treasury bills having further three types: the 91 days treasury bill, the 182 days treasury bill, the 364 days treasury bill. And the thing and the way by which you can remember these three types of bills are, I just multiply this by 2. Then multiply this by 2. Just into 2, and you'll be able to remember the three types of treasury bills. Okay, then you have the treasury notes, maximum 1 year, that is like more than 1 year. You are holding those securities and bonds for more than 1 year up till 10 years. And you get the rate of interest semi-annually or biannually. Then in T bonds having more than 10 years but less than 30 years and getting the rate of interest from 3 to 6%. 6% is like 3% for first 6 months and 3% for the next 6 months, right? So this was about the government securities. In the next session, I'll be talking about the tax saving schemes. Okay, so that's all for today.